So you probably heard Ken Moraif's paid commercial announcement radio show and his 30-second radio spots in which they say, clients that followed Ken's advice did not lose money in the stock market crash of 2008. First of all, that's not saying much because any conservative retiree investor who was properly diversified didn't lose money in 2008 either. In fact, with a conservative mix of 30% in an S&P 500 index fund and 70% in 10-year treasuries, you didn't just break even if you stayed the course with a simple buy-hold strategy. You were up 3.1% in 2008. So anyway, there's basically three different types of advisors. You have the guys who are non-fiduciaries who sell expensive commission-based financial products like annuities, life insurance products that combine insurance with investments, actively managed mutual funds, non-traded REITs, limited partnerships, etc. Then you have the guys who sell services, advisory services, but typically they want to constantly manage your money so they can keep charging you. And lastly, we have fee-only fiduciary advisors who sell advice but will do so on a one-time or one-task basis. And since fiduciary advisors legally work for you, they should pretty much tell you to buy, hold, and rebalance super low-cost index funds, bond and stock index funds. Now, as you can imagine, there's not a lot of money for Mr. Advisor if he tells you to buy, hold, and rebalance index funds. He charges you for a one-time consultation. You're at the door and you invest with E-Trade, Ameritrade, or Scottrade and rebalance as needed. But so if you can't do it yourself, it's very easy. Then your lowest cost option is to go to a fee-only fiduciary advisor on a one-time or one-task basis. Now, as far as I can tell, Ken Moraif is selling an ongoing service. According to a post on Bogleheads, Moraif generally charges a fee of about 1% of assets under management. I'm also assuming for this demonstration that I'm going to do that Moraif would recommend that his clients invest in low-cost index funds like VOO, which is the same type of fund that a buy and hold investor would invest in. By the way, if I'm factually incorrect about anything in this video, just shoot me a message and I'll correct it or post a pop-up message. So on Ken's paid commercial announcement radio show, he makes this statement of opinion that it's critical to have an exit strategy in your retirement plan. And I'm like, really? Who are you kidding? Because market timing is something that, as far as I know, all the most respected experts have said doesn't work over time. Experts like Warren Buffett, John Bogle, Peter Lynch will all tell you that you are more likely to get it wrong than right. In other words, you are more likely to simply miss out on gains by being out of the market because the stock market generally goes up over time, not down. In fact, this is confirmed by the investment company Vanguard, which does not recognize market timing as anything that an advisor does to create value as an advisor. Now, I'm sure Ken Moraif is going to stand up and say, I disagree, my services have been a net gain from 2006 to present, and that may be true, but the true test is the long-term test. And for what it's worth, John Bogle has said that it is a mathematical certainty that over a lifetime, you cannot beat the indexes with active management. And here's a few more quotes from respected experts. You can pause the video and read them if you like. Now, probably the foremost expert on studying market timing is Mark Hobart, who has been tracking the advice of over 180 newsletters since 1980. He studies people who attempt to time the market, and he says that his data backs up what he calls his 80-20 rule, which is that 80% of market timers fail over any reasonable time period. And he says, I don't like those odds, neither should you. And as recently as August 8th, 2014, he wrote an article called Timing the Market is Guaranteed to Make You a Loser. So anyway, how has Ken Moraif's strategy held up? Well, hypothetically, if you signed up in 2007 and invested $100,000 in the S&P 500 index, And by the way, I don't know if Ken charges his management fee quarterly, annually, or if it's prorated daily, but for simplicity, I'm going to say he charges 1% on the first trading day of every year. And if I'm wrong, and if it's quarterly, monthly, or prorated daily, then just pretend we go back an extra year of management to 2006. So Moraif told his investors to get out from November of 2007 until June of 2009, and after fees, this would have saved his clients approximately 29%, which is impressive. However, according to a blog called Investment Mythbusters, he got it wrong in 2010 and 2011, missing out on gains of 11.2% in the S&P 500 total returns and 10.1% in gains in 2011. And of course, he's charging fees all the while too, so that approximately 29% of savings has narrowed considerably over the years, and as of January 2015, those early investors have seen their $100,000 grow to about $187,500. Whereas the buy and hold investor is actually not that far behind at almost $173,000 for a difference of only 8.43%. So now what about all of the Johnny-come-lately, jump on the bandwagon, cherry-pick the guy with a hot hand investors who got on board with Moraif after 2009? Well, they haven't fared so well. If we go from January 2010 to January 2015, and this time for mathematical simplicity, I assume that Moraif charged his 1% fee after each year instead of on day one. So anyway, all of you people who got on Moraif's bandwagon after 2009 and followed his market timing advice, it looks like you are behind the 8 ball by nearly 28%. You're almost $46,000 in the hole, you stupid idiots. All because you went to some free sales pitch, a seminar. But I hope those chocolate chip cookies tasted real good because you've been missing the boat. And I know what you're thinking. Well, the market's going to crash 28% any day now. Ken Moraif is going to get it right like he did back in 2007, and then I'll be back to even. Well, actually, you're probably going to need more than a 28% crash because it's nearly impossible to pick the exact market top and then guess the exact market bottom. And what I can tell, it looks like Moraif uses some variation of a stop-loss strategy, meaning he doesn't sell until the market has already gone down some, and he doesn't get back in until the market has come back and shown consistency. For example, from 2007 to 2009, the stock market lost 56.7% from peak to bottom, but Moraif only averted 29% of that total 56% loss. So in reality, to make up for that 28% in lost gains, you really need for the stock market to crash quite a bit more than 28%, maybe 50%. But is that likely? The problem is that crashes of 50% are rare. By the way, there's nothing new about stop-loss strategy if you really want to go against what so many experts say about not doing it. And there's other market timing services out there. You don't have to pay some guy who's going to siphon off 1% off your savings every year. For example, Bob Brinker has a market timing service that costs $185 per year, regardless of the size of your account. But if you agree with the experts like Warren Buffett, then just invest in index funds, then hold and rebalance. And if you can tie your shoelaces, then you can place an order for an index fund with E-Trade. It's easy. Also, watch this video on how to invest your money.